Tate & Lyle traded at roughly half its value of 5 years ago before a U.S. food ingredients firm stepped in and offered a 64% premium to buy it. That premium, 615 pence per share, broken into 595 pence in cash and 20 pence in dividends, was not built on a sudden improvement in Tate & Lyle's trading outlook. The business had faced declining revenue and weak demand in the U.S. bakery market, lower European pricing, and rising costs. Deutsche Bank had spent years arguing the stock was mispriced relative to its peer group. The evidence for that view arrived not from any re-rating by London investors, but from Ingredion's acquisition offer, confirmed on Monday after Tate & Lyle's board recommended acceptance. The FTSE 250 company's shares rose nearly 15% on the day, touching levels not seen in close to a year. Ingredion, by contrast, fell 2.8% on the news. Elsewhere in the session, the FTSE 100 ended flat, just barely positive, as Iran and Israel exchanged overnight strikes for the first time since the April ceasefire, and investors watched the U.S. push to preserve the truce. Oil prices eased slightly through the afternoon. Severn Trent dropped 1.4% after Deutsche Bank cut its price target, and the broader market absorbed the geopolitical noise without significant damage. The Tate & Lyle announcement sat at the top of the corporate agenda, in a session that otherwise lacked a clear directional catalyst. The combined Ingredion Tate & Lyle group is expected to generate revenues of approximately $9.9 billion. The deal is conditional on regulatory and shareholder approvals, with an expected close in the second half of 2027, and Ingredion has until June the 11th to make a firm offer under UK takeover rules. The 64% premium reveals a gap that had been visible in analyst notes for years, but that the London market never closed on its own. Deutsche Bank's valuation work placed Tate & Lyle at 15.1 times forward earnings and 8.4 times enterprise value to EBITDA on 2026 estimates, multiples closer to the company's peer set than to where it was trading. London investors did not move the stock to that level. Ingredion did, by writing a check. That gap between a professional valuation framework and the price at which the stock actually cleared in the market is the observable fact the deal forces into view. The question it raises is whether the gap was a Tate & Lyle specific problem, management underperformance, a weak earnings trajectory, a credibility deficit with domestic investors, or whether it reflects something in the pricing environment of the London market itself. Tate & Lyle's situation is not unique. Wise, Just Eat, TUI, and BHP are among more than 150 companies that have left the London Stock Exchange or transferred their primary listing elsewhere since the start of 2024. Each of those departures came with a company-specific rationale. The Tate & Lyle transaction adds a different kind of evidence, not a company choosing to relist in New York for valuation reasons, but a foreign buyer identifying sufficient discount to justify paying a 64% premium to take the business private from London entirely. Ingredion shareholders are pricing in the execution risk on the other side of that premium. The 2.8% drop in the acquirer's stock signals that the market is not treating this as a straightforward arbitrage. The position pressure sits on holders of Ingredion shares, who now face a 2 to 3 year integration horizon, and on London-listed UK industrials in adjacent sectors, where no firm bid has arrived, but the discount, if it exists, has now been independently verified at 64%. If Ingredion submits a firm offer by June the 11th, which the current recommended deal structure implies they will, the next question shifts to whether the 64% premium was the right number, or merely the number required to move Tate & Lyle's board. Deutsche Bank's buy rating and price target of 595 pence had set a ceiling before the deal. The offer at 615 pence cleared it by 20 pence, precisely the dividend component. That narrow overshoot suggests the negotiation ran close to what an independent valuation framework supported, which in turn implies the board was not holding out for speculative upside. The verification benchmark is the 615 pence offer price measured against Tate & Lyle's trajectory in the period between deal completion, expected in the second half of 2027, and the combined group's first full reporting cycle. If the combined entity trades above the implied acquisition multiple at that point, Ingredion shareholders will have absorbed the initial £1.4 billion premium cost against a durable long-term gain. If it does not, the 64% paid to London holders will look, in retrospect, like the better side of the transaction. That asymmetry is the actual test of whether London's discount was real or temporary. On the broader LSE exodus, the signal this deal adds is different from a voluntary delisting. It is a foreign buyer confirming the discount in cash. For UK-listed mid-cap industrials in food, consumer ingredients, and specialty chemicals, sectors where similar valuation gaps have been identified by sell-side research without triggering domestic re-ratings, the Ingredion offer is now a pricing reference point. Whether that reference attracts further inbound acquisition interest or prompts London to adjust how it values these businesses is the unresolved question. The deal does not answer it. It only makes the question harder to ignore. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.